Hello friends. Last week in my video, I said the bulls were getting back in the driver's seat and I followed it up with my Live Mint article saying that the markets would conquer a new life high. That happened. But what happened on Thursday and Friday seems to have sown the seeds of doubt about whether this rally will continue and whether there's likely to be steam in the markets left to surge the markets to another high. In this video, I'm going to answer those doubts. So let's dive right in. On your screen right now is a market roundup window which tells you that the broader based Nifty 50 led the rally and the Bank Nifty followed up from behind. The US dollar index continued to fall. It fell 156 basis points. And that was a pretty big relief for emerging markets, including India. And a weak dollar triggered a bull run in gold and silver, as you can see. Crude oil prices also went up and natural gas came down along expected lines because I told you in my video last week that it had gone up only due to winter and cyclical considerations. The US dollar index fell, which means the rupee strengthened against the dollar, and that basically brought down Indian 10-year benchmark bond yields, which means bond prices went up, another feel-good factor for banking stocks. MWPL went up by 475 basis points, which is routine because after expiry, MWPL does tend to go up, albeit slowly. US indices went up, which provided tailwinds to our market. And on your screen right now is the daily chart of the Dow Jones Industrial Average. Last week, I told you the 34,281 level was a critical area to watch out for. The market went up on Wednesday above that threshold in a huge run up and has closed even on Friday above this threshold. Now, ideally speaking, we want the 34,281 level to become a support and the Dow Jones Industrial Average to trade above it. Incidentally, the death cross has now been reversed because the 50-day moving average is now above the 200-day moving average, which has now become a golden cross. So that's an optimistic outlook on the Dow. Let's take a look at NASDAQ 100, which is responsible for influencing our technology stocks. Relatively compared to the Dow, the chart is weaker because the death cross is still in place. We ideally want the price to stay above the 200-day moving average at least, which is a little under 12,500 for the NASDAQ 100 index. Till such time as the NASDAQ is trading below the 12,500 mark, I think tech stocks are likely to be either sideways or underperform the broader markets. Let's take a look at the S&P 500, the broadest index of them all. It's trading well below the 4,100 mark, which is what I want this index to trade above so that the bulls can basically signal that they're serious about pushing markets higher. Net, the US indices are positive and therefore guidance coming from overseas market seems to be okay. Returning back to our markets, let's start with the MWPL. This is the market-wide position limit, measures the risk appetite of two Marshmallow traders. It tells me that the week after expiry has seen a salutary run up to 27.68%. Now, as long as MWPL continues to rise, it is one of the things that you need to watch out for, and don't worry about it. I update this on my social media accounts every day, so do connect with me. My contact coordinates come at the fag end of this video. So as long as MWPL is rising proactively, I think the markets should be doing okay. This is another green flag for the markets. Now let's take a look at the turnover. Turnover has basically fallen on a week-on-week basis, and do remember this is a week's total turnover, not just Friday to Friday. Now that is basically expected because last week was influenced by rollovers and expiry. So turnover in the week after expiry does tend to fall, and the fact is that it's not fallen any lower than the 20-week period low. That means it's more or less in line. And let's not forget, at new highs, there is bound to be a little bit of trepidation, little bit of hesitation. Let's now go to the advanced decline ratio. After the price, this is the most quickest and leading indicator of which way the winds are blowing. Now, the advanced decline ratio, and this is an average of the 5 days of the week rather than Friday to Friday. What we are saying is the average advanced decline ratio has risen 20 basis points from 115 in the week prior to 1.35 last week. So net, the one Marshmallow traders buying support has been proactive, and as long as this advanced decline ratio line, the week's average, continues to go up, I think the markets are in positive or strong hands. Now, the futures basis. Basis is nothing but the premium enjoyed by the futures as compared to the spot. Higher the premium, more the risk appetite band. As I told you last week, the basis that we saw last week was euphoric at best. I told you this kind of basis cannot last. Over 300 points on the Bank Nifty and over 125 points on the Nifty 50. And there you go. Basis has come down. If you're an options writer, you will remember that options premium tends to decay with theta or time tenure. And that is a factor that's applicable even to the basis here. So as we get closer to expiry, basis will contract. And as long as the basis remains above zero, which means it does not invert, the bulls are still in the driver's seat. So this is another comfort for the bulls. Now for the impetus. Now this is something that I pointed out to you both in my video and in my live mint column, that the Nifty's impetus is rising robustly. The Bank Nifty's impetus is trailing relatively. And there you go, voila! As if by magic, the Bank Nifty underperformed the Nifty last week. Now, even though the Bank Nifty's impetus has risen, it is risen just about mildly. We want a proactive rise, just like the Nifty's impetus line has risen, so that both the indices can rise together and take the markets higher in a broader based fashion. It's not really a critical worry, but this is something that's nagging a little, just a little. Now the LWTD indicator, what we are seeing is that the LWTD has risen for the third week in a row. It's staying above zero, and the week-on-week gain by the Nifty has also remained above zero. So it tells me that bulls are likely to be a lot more proactive when it comes to buying the dips and offering support to the markets. Another green flag. So barring any dips, corrective dips in the market, which I'm going to cover in detail at the fag end of this video in a separate chapter, do stick around. Now for the four market player types, starting with the FIIs, we're seeing the index net long positions come down slightly, as have the individual stock futures net long. So they've basically booked profits at new highs. DIIs have increased their net short positions in individual stocks mildly, and they've cut their net short positions in indices mildly. Why are they always short? Because they tend to buy in the spot segment to support the markets, and they hedge these purchases by shorting in the futures. Not to worry about that. Prop traders have cut their index net short positions from 15,800 odd to 11,000 odd. So that's good. They're expecting the indices to basically remain buoyant. More importantly, they have increased their individual stock futures long positions on a week-on-week basis by almost 20,000 lots. Now that is a sign of optimism. The retail segment has also increased their net long positions in individual stocks as well as index futures. These guys have done all the heavy lifting, so that's optimism again over here. Friends, I now come to the four heavyweight stocks in the Nifty and the Bank Nifty, and wherever these stocks go, there goes the sentiment in the market. Starting with the biggest boy of them all, Reliance Industries, with a weightage of 11.03%. Finally, on Monday itself, it surged past the 2,677 levels where I wanted it to go. Price is comfortably above its 25-day exponential moving average, which is a month-long holding on cost. The average itself is pointing higher. So Reliance is likely to provide a good amount of support on declines for the market as long as Reliance does not fall below 2,618 on a sustained closing basis. The second big boy, HDFC Bank, weightage of 8.26% in the Nifty and the heaviest weighted in the Bank Nifty with a weightage of 25.61%. This stock has basically risen on 2 trading sessions out of 5 last week, stayed almost sideways. But as long as it stays above the 1,541 levels, I think the bulls are still in control. The 25-day exponential moving average is pointing upwards, which means the short-term outlook remains positive for now. Anytime the stock starts trading above 1,650, you will see the Nifty and the Bank Nifty get good support from HDFC Bank. Third in the weightage game, Infosys weighted only in the Nifty 50 at 7.06%. It's risen on 3 out of 5 trading sessions last week. Do remember the Nasdaq 100 in the US markets has also gained on a week-on-week basis. The price is above its 25-day exponential moving average, which itself is pointing higher, and it's crossed up above its August 2022 swing high. What we need to do is go past the 1,728 levels for a W-shaped breakout, upward breakout, and then provide comfort to the Nifty. Let's wait and watch here. Now, the fourth last stock in the heavyweight list, ICICI Bank is a trend determinator both for the Nifty due to the weightage of 7.94 and Bank Nifty weightage of 24.62. It's the second heaviest weighted stock in the Bank Nifty after HDFC Bank. Price has come down sharply on Thursday and Friday, but it still remains above the 25-day exponential moving average, which is a month-long holding on cost of an average bull. As long as this moving average is not violated on a sustained closing basis for 1 or 2 trading sessions, I think the bulls are still in the driver's seat, although I expect some profit taking to come on ICICI Bank in the coming days. So net summation, 3 stocks, which is Reliance Industries, HDFC Bank and Infosys seem to be either up or sideways, and ICICI Bank seems to indicate a little bit of profit taking. Net, not too bad a situation. Now, friends, I come to the bond market, and those of you who know me know that I have a great deal of affinity for bond markets, especially the 10-year benchmark bond yields. We have seen the bond yields come down on a week-on-week basis, as the weekly chart on your screen basically tells you. We've come down to 7.22%, and what we are likely to see is a test of whether the bulls can hold 7.10%. If 7.10% holds, the bond prices are okay. If 7.10 breaks, that means bond prices are going to go up significantly, and that might trigger some amount of bullishness in the Bank Nifty. Should you consider continuing with your laddering process? I think you should hold back a little, because deploying money at 7.22, especially since we've seen 7.5 plus percent yields in the recent parts, seems to be a little premature. So let's hold on to our checkbooks for a bit and consider deploying money at somewhat of a later stage. Connect with me on social media. I will update my view on any change in the view on laddering in the bond markets and sovereign investments scenario. Friends, the bond market's done. I now come to the US dollar index, which is a trend determinator for both equities, commodities, and even in the USD INR in India, so the currency market. And this index has continued its downward slide. As you can see on the daily chart on your screen, it fell on 3 out of 5 trading sessions. and the closing has halted at the level that I advocated last week for watching was 104.51. That's the previous swing low of August. The price is below its 25-day exponential moving average, which itself is turning lower. The moving average indicates a month-long holding on cost of an average bull. Those guys are underwater. And unless the price goes above the 107.5 levels, I don't think the bulls are going to get any respite. What if the 104.51 mark breaks sustainably on a closing basis? I think in that case, the next inflection point to watch out for would be 102.50. Coming to the weekly chart, what we are seeing is a long-term trend line which formed in May 2021 is offering support at 102.50. The price happens to be below the 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. It's the 4th week the price has stayed below this average, so the medium-term outlook has turned a little shaky. But the fall towards the trend line is more of a mean reversion trade rather than a huge long-term bearishness. I would watch the 102 level very, very keenly because that's where the next war between the bulls and bears is likely to be fought. Friends, last week I advocated a range between 108.5 on the upside and 103.60 on the downside, which held perfectly well in spite of all that volatility. In the coming week, I expect a range between 107.02 on the upside and 102.02 on the downside. Do keep your eye on the US dollar index, please, because trends in commodities, currencies, and equity markets depend on this. The dollar index done, I now come to the Bank Nifty, which rose 0.28% on a week-on-week basis. It fell only on one trading session, which is Friday, out of the entire week of 5 days, as you can see on the daily chart. Though Thursday itself saw some signs of challenges or weakness for the bulls because the closing was significantly lower than the open, even though net on a day-on-day basis, the Bank Nifty gained on Thursday. But it was a little jittery. The swing high at 41,840, which I have marked, which was a September swing high, will act as a support on the downside to watch out for. As long as the price remains above this threshold, the bulls still have a chance. The price is above the 25-day exponential moving average. That's a month-long holding on cost of an average bull, so the short-term outlook remains optimistic for now. Coming to the weekly chart, what we are seeing is the weekly bullish candle is a very small one where the body is concerned. So the momentum is slowing, no doubt about it. The price has run significantly higher than the 25-week exponential moving average. That's a 6-month long holding on cost of an average bull. A mean reversion might be seen. What's a mean reversion? Where the price either goes down towards the moving average or it goes sideways and the moving average continues to rise to meet the price at some point in time. So some consolidation might be in order. I think it is early days yet to say that the markets are due for a trend reversal or a big collapse. So that's the outlook as per the weekly chart. Friends, in the week before last, our in-house statistical beta list, the list of most volatile counters, saw the Bank Nifty at number 4. But last week, it rose one notch to number 5. The reason being that volatility and impetus, like I showed you on the impetus chart previously, was lower than the Nifty 50, which is good. The lower the volatility, the more steadiness in the price, and therefore retail traders can trade with less amount of stress. Last week, I advocated a range between 44,375 on the upside and 41,600 on the downside, which held perfectly well. In the coming week, I expect a range between 44,450 on the upside and 41,750 on the downside. Continue to trade light because this market is likely to basically see higher statistical beta or intraday price volatility. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 0.99%. It rose on 4 out of 5 trading sessions last week, as you can see on your daily chart on your screen. Sentiment started turning a little weak on Thursday itself, late in the day, because the closing on Thursday was significantly lower than the open. I think at any time at the price point at which we are in, we've crossed the 18,604 level, which is the October 2021 all-time high of the Nifty. We've crossed that threshold. Now the weaker hands are showing signs of nervousness and exiting long positions. So there has to be a change of ownership pattern. Strong hands must buy from the weak hands, and therefore some amount of jitteriness could be seen. The price is above the 25-day exponential moving average, which is pointed upwards, which tells you that the short-term outlook also remains optimistic as of now. As long as the price remains above the 18,100 levels, I think the bulls are still in charge. The weekly chart of the Nifty says the price is significantly above its 25-week exponential moving average. That's a 6-month holding on cost of an average bull. Some consolidation and mean reversion might occur, so either the price falls to meet the average or it goes sideways and the average rises to meet the price. In either ways, the uptrend might slow down a little, but it's too early to say that the markets are going to collapse or they're going to reverse. That would be premature and that would also be incorrect. So I don't think the rally has petered out just as yet. In the week before last, this index was number 12 on the statistical beta ranking list of most volatile counters. Last week, it rose 3 notches and closed at number 9. That's challenging for a retail trader. A heavyweight index like the Nifty 50 gaining statistical beta tells me that the price volatility, intraday pure price volatility, is rising. That means a probability of more whipsaws for a retail trader to confront. So let's be careful out there. Last week, I advocated a range between 19,000 on the upside and 18,025 on the downside, which held perfectly well. In the coming week, I expect a range between 19,200 on the upside and 18,200 on the downside. And as far as I'm concerned, you should be buying the dips rather than selling the rallies at this point in time, although traded volumes need to be curtailed so that volatility, if any, does not inflict too much damage. Friends, the last bit of charting here, let's check the retail risk appetite by way of their footprint in options and futures, that too vis-a-vis indices versus individual stocks. The sky blue line is the stock options turnover, and that's very clearly surpassed last week's peak. That tells you that retail risk appetite in stocks has gone up because stocks tend to be a lot more volatile as compared to indices. The olive green line again is the stock futures turnover, and the turnover itself has risen. That tells you that traders are preferring to essentially trade stocks in futures and options, and risk appetite therefore is higher because stocks move 3 to 3.25% intraday, whereas indices move up to 1.75%. They are willing to take higher volatility risks. Now, where the Nifty's, the indices turnover contribution to the entire contribution here has fallen below last Friday's levels. That tells you that action is now shifting from indices to individual stocks. That is a sign of a rising risk appetite, which means that the bulls are not willing to go just as yet. Friends, I promised you I would sum up as to what I think about the rally. From what the data I have shown you so far, I have surmised that there is a regular or a routine profit taking by weaker hands who are saying this far and no further. I've made enough money. I think I don't want to risk losing the money that I have already made and notional profits. So let me just sell out and book my profits. All perfectly valid, and to each his own. Depends on a person's risk appetite. A person locks in gains. Now, what will happen is that the guys who want to buy the stronger hands who want to buy from the weaker hands are in no hurry to buy at any given point in time. They would let the market slide lower so they can buy at cheaper prices. So maybe when the retail guys, the lower risk appetite retail guys keep selling, the buying support from stronger hands is coming in a slightly calibrated or measured manner. That is all right. So the market falling a little bit before rising again would still be constituted as a routine correction. Do remember the Dow theory says any decline less than 10% in nature is treated as a routine correction, and only if the price falls 20% or more from the peak does a bear market start. So all is well as long as the price does not fall more than by a few percentage points. Friends, I now come to the most popular aspect of this video for the statistical minded trader. I give you 5 stocks that have gained the most amount of impetus on Friday. So you take a small exposure on Monday, wait for large price moves, and 5 stocks that have lost the most amount of impetus on Friday. So on Monday, you take big exposure, wait for small price moves. That's for scalpers. Do remember this list is valid only for Monday. If you want this list on Tuesday through Friday, please subscribe to my Telegram channel. The links are there in the description and at the fag end of this video. So the impetus gainers list is led by Dabur India, Shree Cements, LTTS, Jindal Steel and OFSS. Impetus losers for the day: TVS Motors, NMDC, Bajaj Finserv, India Mart and Aarti Industries. Friends, before I sign out of this video, let me remind you to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comment section, do let me know how my videos help you to become better traders. Also, help me reach out to a larger audience of like-minded smart traders like yourselves by sharing my videos with your social media groups, friends, and family. Thank you for your patience in being with me in this video. Till we meet again in my next video, this is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Bye-bye.